Hi everyone, this is Natalya and I'm a CPA with Colorado Business CPA. We work with small businesses and help them to save money on taxes as well as help them to grow their successful businesses. So today I would like to share information about 7 ways to save money on taxes. And it depends on the situation. It can be from somewhere from $10,000 all the way to $30,000. Okay, so the very first thing what you need to do if you are making at least $30,000 to $40,000 in net income, meaning gross revenue minus expenses, net income about $30,000 or more, and you will continue growing your business, you need to convert your limited liability company or sole proprietorship you cannot convert into a S corporation. You have to have a limited liability company and then convert your limited liability company into an S corporation. And by doing that, you will save money on payroll taxes because the net income from S corporation is not subject to 15.3% Medicare and Social Security tax. However, IRS doesn't really like this idea, so you would need to have a reasonable salary and subject that to self-employment tax, which is, you need to have a W-2 income and then subject that to self-employment tax. But again, think about if your net income of about $100,000, if you have an LLC, that's $14,130 in self-employment tax. And then if you have an S corporation and you run a W-2 for $40,000 and you pay a self-employment tax, but then you take $60,000 as distributions from your S corporation, and therefore, you will have about $8,000 in tax savings. But again, keep in mind that reasonable salary is a must to keep you out of trouble with the IRS. Okay? So the next thing that you need to do is the Section 199A optimization. This is a new rule. This is a new tax law. And, the net income from the businesses, from the pass-through entities such as sole proprietorships or S corporations or LLCs, partnerships, the net income of, let's say you have a net income of about $100,000, the 20% of that income is not going to be taxable. In fact, you will get a deduction. But again, there are rules. There's a personal service companies and there's also trade of business. So it depends on what type of business you're running, then it would depends on those rules. I'm pretty sure you would need to talk to a CPA about where you are. But Section 199 optimization is a great way to save money on taxes, because what happens sometimes, let's say business owners have an S corporation. They run the S corporations and they take their entire income as a W-2. Not only they kind of defeated the purpose of being an S corporation, because now all of their income is subject to self-employment tax because they pay themselves a W-2, but then also there's no income to have that 20% deduction. So I believe, if you're, entrepreneur who grows his or her business, you should have this issue discussed with your CPA to say, okay, how can I maximize my tax savings by utilizing Section 199A, but also not to get myself in trouble with the IRS, because if I have a very little W-2, I can get in trouble with the IRS about the not paying enough in the payroll taxes. So then what we offer for small business owners, visionary entrepreneurs, is the monthly plan, which helps you to maintain your S corporation status. And so we will file your S corporation tax return as well as your 1040, your individual tax return for the year. We also look closely like what's your S corporation shareholder salary should be, to optimize to take the advantage of the Section 199 deduction, as well as not to get you in trouble with the IRS, as well as to save enough money on the payroll taxes for you. And then, we do all the payroll filings. You'll have a direct deposit for your from your company as an employee. Also, will file the payroll reports. We will file up to 5 forms 1099 miscellaneous to your vendors, subcontractors. We'll also do a tax planning, as well as the to estimate what the tax payments you should be paying throughout the year. and we will give you the IRS audit protection, meaning, if you get audited on this particular year of the tax return we have prepared, we will represent you an IRS audit for free, which can easily be about $10,000 in value. Trust me, those audits can be very expensive. So, and that's for $240 a month. We'll take care of this entire package to maintain U.S. corporation, or $2,880 per year. So if you're interested, please call us. It's 1-800-5040-CPA, 1-800-5040-272, or coloradobusinesscpa.com. So the next thing we want to discuss is, as a tax saving tool, is paying your children. If your children are helping you in your business, and the best scenario, the best tax savings tip would be if your children are under 18 years of age and you have a LLC taxed as a Schedule C limited liability company with sole proprietorship. And if you pay your children, you can pay up to $12,000 per child, and it's going to be tax-free. Obviously, again, children need to pay. Children need to work for you, truly work for you, because this is a very highly audited, again, area. Because it's people might not work for you, right? But you want to make sure children do work for you, and and then let's say you pay them $10,000, but your tax returns, perhaps maybe you in the 40% tax bracket, by shifting that income $10,000 from your business to your child income, there's a 40% to 40% tax rate on your return. You just saved just $4,000. And then it gets better. Now your children have earned income, and then you can actually contribute on their behalf to their Roth IRA, which also helps them to build a financial net worth at such an early age that they can accumulate their earnings, and they can already start building their net worth, which is really great tip. So another thing is, like, if you're running your business as an S-corporation and you have children who work for you under 18 years of age, you can also create like a small management company, which you will be an LLC, and then your kids can work through this LLC, and then the S corporation pays to the management company, and then you run a payroll to your children from your management company. Thus, again, they will not pay payroll taxes. But if your children work for you in an S corporation, then the children, doesn't matter how old they are, they will be subject to FICA, Medicare, Social Security tax. So something to discuss with your CPA. Okay. So the next thing, I believe that each business owner, successful business owner, has to have a retirement plan. Because remember, when you run your business as an S corporation, you're only subjecting half of your net income from your business to payroll, Medicare, Social Security tax, and therefore it will be reflected on your Social Security benefits when it's time for you to collect on the Social Security. And as you might think, and you will be right, is your Social Security benefits will be less. And therefore, we strongly recommend you to have your, business retirement plans through your business, which you can fund. And not only you will save money on taxes while you're funding those, but also you're building a financial net worth. And there are several plans available. If you have no employees, you can use a SEP IRA, and the amount of contribution is 20% of the net income from Schedule C if you run your business as a Schedule C, or 25% if you run it as as an S corporation. So it's 25% of your W-2, subject to Medicare, Social Security, FICA taxes. Again, it's a great plan when you have no employees, because if you have employees, then you have a 25%, so you have to match basically 25% to of the employee and W-2 wages for them as well. So that might not be the best plan when you have employees. Maybe the simple IRA or 401k would be the best plan, which we will discuss shortly. But what's good about the SEP IRA is it has flexibility. If you run, your business even as a Schedule C, let's say, and you have $100,000 in net income, and you can contribute roughly $20,000 into a SEP. But let's say now it's January and you don't have the money yet. So you can contribute up to the time frame for 2018. You can contribute to your SEP when you file your tax return. And the latest date you can file your tax return for 2018 is October 15th. So you still have almost 10 months to fund your SEP IRA, and then file extension on your individual return by April 15th. Pay with extension if you think you owe money, but you can also calculate that SEP IRA you will deduct, and then look at your tax liability, pay the money with extension by April 15th, and then wait a few more months, and then file a Form 1040, and then after you fund your SEP. So again, very flexible in terms of the timing. Again, if you have employees, a simple IRA would be an option. You can contribute $13,000, and if you are over 50 years old, you can actually put another, I believe it's another $6,000. So that would be $19,000 into simple IRA. And then also, you have a 3% match, and then employee, you also do a 3% employee match for each of your employee. And then, the obstacle is the backdoor conversion. So if you have to do conversions from the IRA to Roth IRA. Another option would be a solo 401k, and you can put a $19,000 into a solo 401k as employee contribution, and then plus $6,000 as the catch-up, so you can contribute $25,000 into a solo 401k plus 25% of the FICA wages. Again, it's a good solo 401k. It's a good plan when you have no employees. It's not expensive to maintain, and then both working spouses in the business is okay still to qualify for the solo 401k. And of course, if you have employees, 401k would be another option. Your employees can contribute $19,000. You contribute $19,000. Make sure if your spouse is helping you, make sure he or she contributes $19,000. If you're over 50, you can do another $5,000 catch up. So you have $25,000 as employee contribution plus about 3% match. So it's also a great plan for you for the retirement. And of course, there are other plans available, like if you want to contribute $100,000 into the IRA, and right now it's outside the scope of this presentation. So the next thing is the home office tax deduction. So a lot of people, kind of like they're confused, they're not sure, should they take the home office deduction because they're concerned about IRS audit risk. And what I say, well, if you have your home office, if you use this space regularly and exclusively, and your office does not have any beds, then absolutely take a home office deduction. Take a internet expense, telephone expense, obviously cell phone, and then like if you can take a home office deduction. There are two ways, obviously. If you have a Schedule C LLC, you can use the Form 8829. You will be using the Form 8829, and then you will allocate the expenses between a direct, which is direct expense, meaning directly relates to your home office. For example, if you change the carpet in a home office, right? And then there are indirect expenses, meaning, let's say, the mortgage on the entire house, and then you just take the portion. So how can you calculate the home office deduction? You can do a standard deduction. In the standard simplified method, it's $5 per square foot, and you can take up to $1,500, so 300 square feet, and then you can take the percentages. Let's say you have an entire house, 2,000 square feet. You have an office, let's say 100 square feet. So you take the percentage of that, and then you will basically take the percentage, and you will allocate the entire cost of the house by that percentage, and that would be home office deduction. So again, if you work for an S-corporation, you should have some type of accountable plan, and then reimburse yourself from the S corporation. Do not put those expenses as a miscellaneous, because there's no more 2% miscellaneous deductions allowed on Schedule C. And again, also keep in mind that if you use a regular home office deduction, you also need to allocate the cost of your house and then depreciate that over 39 years. And then when it's time to sell the house, you also have to do depreciation recapture. But overall, it still can be very beneficial. Depending on the situation, you can save somewhere, from $1,000 to $3,000 on taxes. Again, depending on the situation. I would not recommend you to take more than 20% of the business use of the office, because then it can trigger the IRS audit risk. Okay. Audit expense. A lot of people ask me, what should I do? Should I take mileage or should I take the actual expenses? So rule number one, you keep track of the mileage no matter what. Because if you take the mileage expense, you have a 58 cents per mile to take the mileage expense. And if you have a fairly inexpensive car and you drive a lot, perhaps taking the standard mileage deduction is the very beneficial for you, right? And then you can also, it's either or you can choose to take the actual vehicle expense. Let's say you purchased a construction car, like a truck, which is more than, let's say, heavier than 6,000 pounds, and you can deduct the entire cost of the truck in 1 year. But again, you still need to keep track of the mileage so you can see what's the business use of that truck, what's the personal use. And if it's 100% business use, meaning you have another vehicle you use for personal needs, you can deduct the entire cost of the truck. And for the actual expenses, you can deduct the insurance, gas, repairs, maintenance on the vehicle. And again, sometimes I tell people, well, yes, taking the depreciation in 1 year sounds really good. But then, what's your long-term strategy with this truck? Are you planning to keep this truck for like at least, 10 years? Then maybe if you want to take the expense, depreciation expense in 1 year, great. But also keep in mind, if you purchase this vehicle with the loan, then you have to pay maybe for another 6 years, you have to pay the loan down. Well, you take the advantage of that cost of the vehicle in year one, but you still have another 5 or 6 years to make payments on the vehicle. So you'll have the cash outflow, but you have no benefits. You don't have any more tax benefits to offset that. So, and again, if you're planning to sell your truck 2 years from now, do you really want to depreciate the entire truck? Again, everything, it depends. It depends on your situation. It depends what works better. So again, talk to your CPA. If you don't work with a CPA, we would love to talk to you. Our number is 1-800-5040-272. So, and this is as a Colorado capital gain exclusion. This is a, this is not directly relates to the business, but if you're in a real estate rental activities, and you have properties you purchased in Colorado, like a real properties, tangible properties you purchased in Colorado, and you purchased them after May 9th, 1999, and before June 4th, 2009, and then when you sell this property, you can actually take up to $100,000 exclusion on the property, on the real property. And this information can be found on the Colorado FYI 15. So there's a Colorado for your information 15 bulletin, or just talk to us, your CPA, or talk to us if you don't have a CPA. So there are some rules. You should have the property. You have to own this property for at least 5 years, and $100,000 exclusion on Colorado. In Colorado, only on Colorado tax return, that can save you $4,630. Again, we had clients this year, about 3 clients who qualify for this deduction. This is a very good deduction. So just keep in mind that you might qualify for that if you have rental properties and you sold some rental properties. And again, this is our company, Colorado Business CPA. We are a full service tax and accounting firm. We do a tax planning, but what also separates us from other CPA firms is we offering packages, and one of our very common packages, the intentional growth package. And intentional growth packages with, we basically work with entrepreneurs and we help them to, reconcile their bank and credit card accounts. We help them with the budgets and forecasts. Our accountants have a quarterly meetings, with the business owners to kind of focus on numbers to see if they're on track of, of their goals. We also do payroll processing if they have employees. If you're an S-corporation, owner of the S-corporation, you have to have a W-2. So we file those forms for you. We file the 1099s for your subcontractors. We do a tax planning, prepare tax returns, individual and business. And this is all the compliance piece of that. So this is what traditional CPAs do, that right? And then the next part of it is the gaining, clarity and direction with the coaching. So on top of what we offer compliance work, we also offer coaching. And coaching means we offer a weekly phone call at 9 o'clock on Monday. It's a group phone call where you have an opportunity to ask your question, but then also you hear what other people's asking. Pretty much, business owners have the same issues. And then we also do our quarterly mastermind groups where you're surrounded by the like-minded people on the quarterly basis. It's a one-day event, where we're not only talking about the numbers and tax savings, but we're also talking about how to build a better culture in your business, how to improve sales and marketing. And that's also comes with the one-on-one, not one-on-one, but the mastermind coaching. So, and again, if you think you might want something like this, where you're not only getting the compliance work, but also the coaching, please feel free to call us. It's coloradobusinesscpa.com, 1-800-5040-CPA. We also do lots and lots of videos, so please subscribe to our channel. It's a Colorado Business CPA. Like our video, share our video, and feel free to call us if you have any questions, 1-800-5040-CPA. And again, always make your future bigger than your past. That's what Dan Sullivan says, and he's with the Strategic Coach. So if you have any questions, feel free to call us. So thank you so much. Bye.